Imagine waking up one morning and discovering that your investments have quietly grown into a portfolio worth over $1 million. It sounds like a dream. Many people assume that becoming a millionaire requires launching the next billion-dollar startup, inheriting family wealth, or making a lucky bet on a stock that increases by 1,000% overnight. But history tells a very different story. According to research from Fidelity Investments, the number of retirement accounts with balances exceeding $1 million has grown significantly over the past few decades. The majority of these investors didn't achieve that milestone through risky speculation. They reached it through years of consistent investing, patience, and allowing compound growth to work in their favor. The same pattern appears in studies of self-made millionaires. While many own businesses or real estate, stocks are one of the most common assets found in their portfolios. In the United States, the stock market has historically been one of the most effective long-term tools for building wealth. So the real question isn't, can the stock market create millionaires? History has already answered that. The better question is, how does it happen? And perhaps more importantly, can an ordinary person use the same principles without being a financial expert? In this video, we'll explore the strategies that have helped countless long-term investors build substantial wealth, not through shortcuts or guaranteed returns, but through disciplined investing, patience, and one of the most powerful forces in finance: compound growth. Before we go any further, it's important to clear up one of the biggest misconceptions about the stock market. Many people see headlines about someone turning a few $1,000s into millions by investing in a single company at exactly the right time. These stories attract attention because they're rare. What rarely makes the headlines are the millions of investors who steadily invest every month, year after year, allowing their wealth to grow gradually over decades. That may not sound exciting, but historically, it's been far more common. The stock market was never designed to make everyone rich overnight. Its real strength lies in giving businesses access to capital while allowing investors to participate in the long-term growth of those businesses. When you buy shares of a company, you're purchasing a small ownership stake. If that company grows its earnings over time, your investment may also increase in value. Some companies also distribute part of their profits to shareholders through dividends, which can be reinvested to purchase additional shares. Over long periods, thousands of successful companies have collectively contributed to the growth of broad stock market indexes. This is one reason many experienced investors focus on long-term investing rather than trying to predict short-term market movements. To understand why the stock market has created so many millionaires, we first need to understand one simple idea: ownership. Every successful company creates value by selling products or services that people want. As these businesses grow, they may generate higher revenues, larger profits, expand into new markets, develop innovative products, and increase their overall value. Shareholders participate in that growth because they own a small piece of the business. Consider companies that have transformed entire industries over the past several decades. Businesses like Apple, Microsoft, Amazon, and Nvidia didn't become valuable overnight. Their growth happened over many years as they introduced new products, expanded globally, and increased their earnings. Not every company succeeds, and many businesses fail. That's why experienced investors often diversify rather than relying on a single stock. One of the simplest ways to do that is through broad market index funds, which hold shares in hundreds of companies instead of just one. Historically, broad U.S. stock market indexes, such as the S&P 500, have delivered positive long-term returns over many decades, although annual performance has varied and past performance does not guarantee future results. This distinction is important. Long-term investing is not about predicting which company will become the next technology giant. It's about participating in the long-term growth of productive businesses while managing risk through diversification and patience. That may sound less exciting than chasing the next viral stock, but history suggests it's one of the most reliable approaches available to long-term investors. So if becoming a millionaire isn't about finding the perfect stock, and it isn't about getting lucky, then what is the strategy that has quietly built wealth for millions of investors around the world? The answer begins with a force that Albert Einstein is often credited with calling the eighth wonder of the world, although there is no reliable historical evidence that he actually said it. Regardless of the quote's origin, the underlying principle is very real. It's called compound growth. and understanding it may completely change the way you think about investing. At first glance, becoming a millionaire through investing can seem impossible. If you're investing a few $100s a month, the numbers don't appear life-changing. Progress feels slow, especially in the beginning. This is where many people give up. They expect dramatic results within a few months, and when those results don't appear, they assume investing doesn't work. But long-term investing has never been about quick results. Its strength comes from something much less exciting, but far more powerful: compound growth. Compound growth happens when your investment earns returns, and those returns begin generating returns of their own. Over long periods, this creates a snowball effect, where growth accelerates because your money is working on an increasingly larger base. Imagine rolling a small snowball down a hill. At first, it barely changes, but as it continues rolling, it collects more snow. The larger it becomes, the faster it grows. Compound growth works in a similar way. The early years often feel slow because you're building the foundation. Over time, growth has the potential to accelerate, not because the investment suddenly changes, but because each year's gains are being earned on a larger portfolio than before. This is why experienced investors often say that time can be one of the most valuable assets an investor has. Why time often matters more than timing. One of the biggest mistakes new investors make is believing they must buy at the perfect moment. They wait for the right time. When markets rise, they think prices are too high. When markets fall, they worry prices could go even lower. As a result, they wait. Weeks become months. Months become years. And during that time, their money never enters the market. Professional investors have spent decades trying to consistently predict short-term market movements, and even many professionals struggle to do so. Instead of trying to guess exactly when prices will rise or fall, many long-term investors focus on remaining invested over long periods. This idea is often summarized by a well-known saying: time in the market has historically been more important than trying to time the market. That doesn't mean markets always go up. They don't. Stock markets experience corrections, bear markets, and periods of high volatility. Those fluctuations are a normal part of investing. Historically, however, broad stock markets have recovered from many downturns over long time horizons, although future recoveries are never guaranteed. For long-term investors, temporary declines have often been part of the journey rather than the end of it. The power of investing consistently. Now imagine two investors. The first invests only when they feel confident that the market is about to rise. The second invests the same amount every month, regardless of headlines, market optimism, or market fear. This second approach is commonly known as dollar cost averaging, or DCA. With dollar cost averaging, you invest a fixed amount at regular intervals. When prices are high, your fixed investment buys fewer shares. When prices are lower, the same amount buys more shares. Over time, this creates an average purchase price without requiring you to predict short-term market movements. It's important to understand that dollar cost averaging does not guarantee profits or protect against losses. However, many investors use it because it encourages consistency and reduces the pressure of trying to find the perfect time to invest. For people investing from each paycheck, it can also be a practical way to build long-term investing habits. The psychology that separates long-term investors. Here's something that surprises many people. The biggest obstacle to successful investing usually isn't mathematics, it's behavior. During strong bull markets, it's easy to feel confident. People see prices rising and assume they'll continue rising forever. During bear markets, the opposite often happens. Fear takes over. News headlines become more negative. Many investors panic and sell after prices have already fallen. Historically, one of the biggest challenges has been allowing emotions to dictate investment decisions. This doesn't mean investors should ignore risk or never make changes to their portfolios. Rather, it highlights the importance of having a long-term plan instead of reacting to every short-term headline. As legendary investor Warren Buffett has often emphasized through his investing philosophy, successful investing frequently depends more on temperament than on raw intelligence. In other words, knowing what to do is only part of the challenge. Having the discipline to keep doing it during uncertain times is often even more important. So now we understand the foundation. Long-term wealth isn't usually built by finding one magical stock. It's built through patience, consistency, and allowing compound growth to work over many years. But there's another question that divides investors around the world. Should you try to pick individual companies or simply invest in the entire market? That decision has shaped the fortunes of millions of investors. And in the next chapter, we'll explore why many financial experts believe one approach has historically outperformed the expectations of most individual stock pickers. So, what is the strategy that has helped create so many long-term stock market millionaires? It isn't secret information. It isn't a shortcut. And it certainly isn't about predicting tomorrow's winning stock. History suggests that the investors who have built substantial wealth over decades often shared a few common characteristics. They invested consistently. They stayed invested through both good markets and bad. They diversified instead of relying on a single company. They allowed compound growth to work over long periods. And perhaps most importantly, they understood that building wealth is usually a marathon, not a sprint. The stock market has experienced crashes, recessions, wars, inflation, and periods of uncertainty throughout its history. Yet, over long time horizons, diversified equity markets have historically rewarded patient investors, although future performance is never guaranteed. That's an important distinction. No investment strategy can eliminate risk. Markets can fall, individual companies can fail, economic conditions change. Every investment decision should be made based on your own financial situation, goals, and risk tolerance. If there's one lesson to take away from this video, it's this. The stock market doesn't create millionaires overnight. It has historically helped many people build wealth gradually through discipline, consistency, diversification, and time. Those principles may not sound exciting, but they have stood the test of time. The earlier you begin learning, the more time you give yourself to benefit from the long-term potential of investing. Even if you're starting with a modest amount, developing good investing habits today can be more valuable than waiting for the perfect moment that may never come. Because in investing, time is one of the few advantages that cannot be replaced. If you found this video valuable, consider subscribing for more evidence-based content on investing, personal finance, and building long-term wealth. And if you have a topic you'd like us to explore next, leave it in the comments below. Thank you for watching, and I'll see you in the next video.